Global jitters, 8,000 crores in institutional dumping, and local political tremors, literally all colliding in a single trading session. If you're an active retail investor trying to navigate today's wild market swings, you're in the right place. We need to decode exactly what just happened, so let's jump right into today's market explainer.
So here is the multi-million-dollar mystery of the day. State elections were creating a ton of noise. Foreign institutional investors, or FIIs, relentlessly dumped a staggering 8,048 crores. And crude oil? It surged past the 10,200 mark. By all traditional logic, we should have seen an absolute bloodbath today. Yet, against all odds, the Nifty 50 somehow survived and even closed in the green. How on earth did we absorb that massive shock? Let's trace the footprints.
Looking at today's intraday tug-of-war, it was brutal. We actually opened with a very optimistic 66-point gap up, tracking positive global cues. And for that first hour, there was genuine buying momentum pushing us toward the 24,280 zone. But man, that momentum faded fast. We saw a vicious midday sell-off dragging the index right down towards the 24,000 mark. But notice that sharp V-shaped bounce right there? That is the market fiercely defending its ground, eventually managing a choppy recovery to close up 0.5% at 24,119.
For those of you actively trading the tape, let's map out these crucial intraday levels. The day was basically defined by three distinct phases. That morning euphoria at 24,280 quickly turned into a classic bull trap as the midday sell-off completely wiped out those gains. By 1:30 p.m., the bears had pushed it down to 24,000. But listen, that 24,000 level isn't just a number. It is incredibly psychological. The market firmly rejected prices below that mark, battling its way back to 24,119. The sheer volatility within this narrow range tells us a whole lot about the conflicting forces at play today.
So, where was the smart money actually hiding during all that index chaos? This sector rotation tells the whole story. Mid-caps actually outperformed the large caps by nearly 50%. Realty absolutely charged ahead, surging 2.41%, while the IT sector remained entirely flat, basically acting as a dead weight on the index today. This shows us that despite the FI selling, domestic buyers were actively picking their spots in the broader markets.
Of course, local political developments were a massive theme today as well. Take a look at Sun TV shares, which saw extreme volatility, dropping as much as 9% intraday before settling 5% lower. This movement directly correlated with emerging Tamil Nadu state election trends that showed the ruling DMK party trailing. It's a classic textbook example of how the market rapidly prices in perceived political linkages and shifts in regional power dynamics.
But we have to talk about the real elephant in the room today. 8,048 crores. That is the massive amount of liquidity pulled out by foreign institutional investors in today's session alone. Now, you know as well as I do, when FIIs pull out this kind of cash, it usually breaks the back of the market. So we return to our opening question. Why didn't we crash?
Well, who absorbed that massive FII dumping? Domestic retail power. Domestic institutional investors stepped squarely into the breach to buy the dip. They deployed nearly 3,487 crores. Now sure, even though that doesn't completely offset the massive 8,000 crore FII outflow, the steady, systematic purchasing power of domestic money absorbed the absolute worst of the shock and provided that essential floor around 24,000. Domestic money is absolutely running the sector rotation show right now.
But as resilient as our domestic buyers are, we have some serious macro villains knocking at the door today. The Indian rupee weakened by 39 paise, hitting a fresh all-time record low of 95.23 against the dollar. And this isn't happening in a vacuum, right? It's driven by persistent West Asia tensions, rising inflation risks, and growing concerns over a broader economic slowdown. A weaker rupee means imported inflation, which is something every retail investor needs to keep a very close eye on.
These global jitters and currency woes spilled immediately over into commodities. Crude oil completely detached from the pack, spiking over 5.5% to hit 10,200 rupees. This is the immediate reaction to those West Asia tensions, effectively pricing in a major geopolitical risk premium. And there's a really stark contrast in how safe havens reacted today. Energy prices are surging, partly driven by reports, though they were later denied by U.S. officials, of a possible attack on a U.S. warship near the Strait of Hormuz. That fear alone shot crude up. But metals did the exact opposite. Gold fell 1.3% and silver dumped nearly 3%. Usually you'd expect gold to act as a safe haven during geopolitical tension, but today traders clearly favored booking profits in metals while panic buying oil.
Stepping away from the macro chaos for a second, I found this insight from Piramal Finance's top management absolutely incredible. They have literally doubled their assets under management, yet their operations headcount has remained essentially flat. How? By utilizing high-frequency agent AI and massive document processing. They are matching the operational efficiency of elite global tech firms right here in our domestic financial sector. Now that is a real game changer.
Meanwhile, Reliance Industries is quietly but aggressively future-proofing. They've just secured what is likely one of the world's largest green ammonia supply contracts with Samsung C&T. This isn't just a routine corporate update, it's a massive flex demonstrating global confidence in Reliance's integrated green energy and chemicals ecosystem. Even on these crazy volatile market days, the big players are relentlessly building. Okay, let's shift gears and map out tomorrow's battleground for you active option traders looking at the upcoming expiry. Using this open interest data, the red bars represent call riders building resistance, and the green bars are your put riders establishing support bases.
Let's break those bars down into actionable levels. The data is incredibly clear here. Call riders have built an absolute fortress at the 24,500 level, which will serve as our major resistance. On the flip side, put riders are fiercely defending that 24,000 mark we saw tested today. That is our concrete support. So, we are currently boxed into this 500-point range, and the battle lines for tomorrow's opening bell are firmly drawn.
Which brings us to the final strategic thought to ponder before tomorrow's bell. We have a market clearly divided. FIIs are hitting the sell button hard, while DIIs and domestic retail are standing strong, holding the line at 24,000. With global tensions pushing up crude and depressing the rupee, all eyes will now turn to the upcoming Q4 corporate earnings. So the fundamental question is, will those earnings be strong enough to break through that massive 24,500 resistance wall? Plan your trades carefully and stay disciplined out there.